So today we have learned a lot. Today we have learned a lot. Let's continue with fractional disparity. Can you hear me?
Okay.
So fractional disparity, this is the part where we look on the relationship among pairs. So these triangles here show the relationship among pairs. We have the major pairs. This one is the major pairs triangle. We have the Euro USD, the Pound USD, the dollar index, Euro Swiss franc, the NZD, USD, UJ. So this triangle shows the major pairs. Can you hear me?
Yes.
Okay. You should understand that any cross pair is made up of two major pairs. These are the crosses down here. These are the crosses. These are the majors in each triangle. And you can see here, this GN, this is Pound New Zealand, is made up of two major pairs, GU and NU. Pound USD and NZD USD. So Euro Yen is made up of two major pairs, Euro USD and USD JPY. Euro Pound is made up of Euro USD and Pound USD. So each major pair, each cross pair have its own triangle made up of two major pairs. And we have other triangles which shows the relationship of pairs depending on a certain currency. So this triangle here, the major pairs here have a common ground that they all have USD. Wow. Can you hear me?
Yes. This looks very confusing.
This is confusing.
Yes.
Well, you just listen. So these webinars are recorded.
Okay.
These webinars are recorded. So you just listen, I record it. You will understand a few things here, but you come back and listen more on the webinar. As time goes on, you will come to understand. See, it even took me time to understand the fractional disparity.
Okay.
But it's not usually very applicable to the trading.
Okay.
This is simply to understand the relationship. So this triangle here has the pairs here have a common ground that they all have USD. They all have the dollar, whether it's the base currency or it's the quote currency. I hope you know about the base and the quote currency.
Yes.
So this one have the USD as their common base. This triangle has the yen as their common base. This has the Swiss franc, the Audi, the New Zealand, the CAD. So these pairs have a relationship because of the currencies, of the common ground that they have on the currencies. The common currencies brings about the relationship. So you should understand that sometimes pairs may move along, like you may see Euro USD is buying, Pound USD is buying, Audi USD is buying, USD Swiss franc is selling, USD CAD is selling, USD JPY is selling. So you may find out that this triangle is moving, the pairs are moving because of the USD. So the dealer is using the USD pair to move a certain currency. I mean, it's using the USD, it's using the dollar to move the currencies, the currency pairs. Sometimes you may see the yens are moving in the same direction. Like the movement is big and it's on the yen pairs only. So you should understand that dealer is using the yen there to move the currency pairs. Sometimes the Swiss francs can move along. Sometimes the Audi pairs. And it's difficult to capture the move for all the yen pairs, all the USD pairs. But sometimes you may notice that they are moving along. But sometimes it may happen that Euro yen is moving long, pound yen is moving long, like they are buying, but USD yen is holding. Like there's a W there. You have entered a trade on USD yen, but the dealer is still holding the pair. But these other pairs, the yen pairs, have big moves. So you can ask yourself, why is USD yen not moving? So the answer to that is that USD yen has no enough liquidity for the dealer to swing it. So the dealer is still collecting liquidity there in order for him to swing the market away. He's still collecting contracts there. So the daily market liquidity for the pairs, this was statistics taken in 2016, is that for EURUSD to move, it has to reach a certain liquidity of 1.173 trillion for it to move. Pound USD for 470 billion. So the dollar index 4.57 trillion. We have the euro pound, it has 100 billion. So for it to move, it had to reach this liquidity. Dealer needs to trap this liquidity in order for him to swing the market away. So when you see a pair is holding, you should know that the liquidity there is not enough for him to swing the market away. So the dealer might extend a stop hand there, and then after he has enough liquidity, he will swing the market away. So you can keep holding the pair, or you can scratch out and wait for a stop hand there. After he gives you the second pattern, then you enter. See, in MMM, we have a rule that if you enter a trade and in 2 hours, you are not in profit, you're not in any significant profit, then you should expect another stop hand and another pattern for the dealer to move. Like the liquidity is not enough. So if you enter a trade and in 2 hours you're not in significant profit, you scratch out, wait for a stop hand, then you enter again. So in fractional disparity, you should be quick in knowing which currency is moving the respective pair, to know their correlation and trade. So is it yen, is it USD, is it Swiss franc? But my advice is that you choose your pairs to trade. You choose only 4 pairs, maybe. You trade only 4 pairs. That would make things easier for you. You should not look up on many pairs that would distract you. You should choose only 4 pairs or 3 pairs, and you concentrate on those pairs. So the disparity there won't distract you. Anything won't distract you. You should simply look for the peak on the pair. So my advice is you choose a few number of pairs to trade. Now, we have learned a lot of things. Now we should narrow them down into 4 phases of focus. So in order for you to have a signature trade, you must pass through these 4 phases of focus and master them. We have the first phase, the before entry phase. We have the entry phase, the reversal, and the take profit phase. So before entry phase, this is the phase where you do your analysis. The phase where you do your analysis, the before entry phase. Here we look on higher time frame manipulation. We look on higher time frame manipulation. We go to the daily and weekly charts. We look for the price action zones. We can draw the support and resistance there. We look for a good peak on the daily. Okay. So this is where we do our analysis. If you see a good peak of the day, then you can have a good picture of what you should look for on the hour 1 chart. On the hour 4 chart, we look on the harmonics and the TDI. That's what we look at. And we come back to from the hour 4, we come back to the hour 1 time frame. There we mark our levels. We mark our MAAW. We mark our WVVM. That's what we do on the hour 1 time frame. So we have our W, we have our V. So you are here and you are doing your analysis. So you anticipate that we are on level 2, we need to go to level 3. So we expect a stop and low and then the dealer will rise. So there you anticipate for your trade. So if on the next day you see a stop and low, then there's a pattern there, you enter without fear because the dealer went with your anticipation. So the dealer simply followed your anticipation. So this is done on the hour 1 time frame. There is where you mark your anticipation.
Okay.
Wait for tomorrow. So another thing to watch before entry are the quarter points and the position of the EMAs on higher time frame. This will take time for you to master them, but you come to understand them. So after you finish your markings, after you anticipate, then we come to the entry phase. So we are in the real market now. The market is moving. We come back to the 15 minutes time frame. There we look on the 15 minutes manipulation. So we look on the Asian box. Is it less than 50 pips? Yes. Is there a stop and that we anticipated? We anticipated for a stop and low, so we see a stop and low. Can you hear me?
Hello.
Hello?
I can hear you now.
So can you hear me now?
Can you hear me?
Yeah, I can hear you.
Yes.
So on the entry phase, we come to the 15 minutes time frame. We look on the 15 minutes manipulation. What's the manipulation there? We look on the Asian box. Is it less than 50 pips? Yes, it's less than 50 pips. Is there a stop and we anticipated for a stop and flow? So we see a stop and flow is there. Yes. As the random pattern presented itself, we have the type 1, type 2, type 3 random pattern. Yes, we have an M there, we have a W. Yes. So it's the 5 or 13 cross there. Yes, it is there. Then you take your entry. Is the timing perfect? The timing is perfect, yes. So you enter your entry without fear. The important thing is to trade in line with the peak. When the peak is low, we look for buy orders. We look for buy entries. When the peak is high, we look for sell entries. Now our stop loss is usually 23 pips from the high or low of the day. So here is the Asian range. So we anticipated for a stop and low, we see 3 swipes down. And then the dealer formed the W here, gives us an entry. So we enter there, we put our stop loss. This will be the low of the day. So we measure 23 pips from there and put your stop loss there.
Okay.
So we wait for the price to go 3 intraday levels. So after you enter your entry, now we come to the part where the dealer will play with your emotions. This is the reversal part. So you have your good entry. So the dealer knows that people are in this trade. So this is the Asian. This is the stop and low. There is the W. So your entry is here. So the dealer moved about 40 pips up. He has his first pullback. So you have your trade 0.1 maybe, 0.1 both sides. So for 40 pips, it's around $40. You see you're having $40 there. And then there is a pullback here of 25 pips. Like the dealer comes all the way to near your entry. Like if he has a pullback of 25 pips, then you'll be reading $15 there. So the dealer there is playing with your emotions. Like you're wondering, is this a real reversal or a fake one?
Okay.
You want to scratch out till you have this fear that this might be the reversal, it might come back. I saw $40, now it's 15. But you should understand that we are looking for 3 intraday levels. So this is a simple pullback. We go for another level. We go for another level. So after 3 intraday levels on the 15 minutes time frame, if you are day trading, this is where you scratch out. As the dealer here would form another M and come back to consolidation. So this is where you scratch out.
Okay.
These pullbacks are there. You'll find them. So
I can't hear you. There, I got you back.
I said these pullbacks are there.
Okay.
That will shake your emotions. So be aware of them. Learn to control your emotions. See, when I day trade, I usually do not break even. You know what's break even?
Yes.
So I usually don't break even on day trade because these pullbacks may take you out on your break even. So I usually leave the price to go until I close the position. But if I swing, this is my peak here. Price has gone level 1 on the hour 1. The dealer is going level 2, then I come to break even. So my entry is around this area. I move my stop loss here. So the dealer has moved the second, is going for the third. I break even again. I usually break even only once, and I want the 3 levels going.
Okay.
So on the reversal part, you should understand which one is the real reversal, which one is the fake reversal. Then you have the take profit part. CTPs are usually statistical probabilities. So you have your TPs depending on the type of trades you take, on the type of trader you want to be. Do you want to day trade? Do you want to swing? So you put your take profit in accordance to that. So my advice is to put your take profit on the ADRs. So if you're day trading, you put on the ADR times 1, on the ADR marker on your chart. Also, and if you're swinging, you should trade the peaks. So if you trade the peak, you can swing.
Okay.
So you should not concentrate only on the entry rules of a trade, but you should concentrate on all the 4 phases. Like on the analysis, you should know how to analyze. You should know how to analyze. You should know the fake reversals. You should take your profits. Now, rules to win this market, rules to profit. So the 4 phases of focus should be mastered. How do you master the 4 phases of focus? You need to mark up your charts. Mark up your charts every day. See, your charts must have the areas and all that. That's why you see Dana having the markups.
Okay.
So you should mark up your charts every day. And in learning, you should mark previous charts also.
Okay.
So that's for you to see them in hindsight. You should see the entries in hindsight so that you can see them when they're happening. And when you mark up your chart, you should anticipate for stop and zone and entry zones a day before it happens.
Okay.
And then you show up to the market every day, no setup, no trade. And you should have your timing to show up to the market. Like you show up on the London and the New York. No setup, no trade. How can you not trade every day? You should be highly selective to your trades. I've taught you many kind of trades, so you should select which trades are you planning to take, and you should master on their entries and how they happen.
Okay.
Then to be highly selective, always trade when the dealer has hit the stops, wait for a stop out. When a trade, when you have missed a trade, you have missed an entry, you should not chase a trade. Never chase a trade.
Okay.
It will happen again, so you wait for another entry. Always trade on the basis of closed candle, preferably with multiple confirmations.
Okay.
And control your fear and greed. Learn to control your fear and greed on trading. I'll not talk of this part because you may take it, you may ban out your account. This part.
Okay.
And another thing, you should not take trades using your phone. Please use your PC. Your PC has many features, so you should use your PC. So there's this part where you learn on the risk management and money management. Forex is an important skill for a trader, but according to the dealers, this is simply a tool they use to scare off the retail traders so that they cannot see profits. They should not see big profits so that next day in the market, you should be there, the next day in the market, the next. So they want you not to see big profits in the market. But risk management is important if you want to be a consistent trader. See, in learning, you should learn the process first. You should not look on the money. You should look on the process. If you enter an order and you simply look on the money that you make after the order has gone into profit, then you will not win on this market. You should only look on the process. Like
Okay.
You should trust the process that this trade will go in my direction and all that. Do not look on the money. So risk management gives you an idea of the risk to reward ratio you'll be using in your trades. So we have the ratios there. We have 1:1, 1:2, 1:3, 1:4, go forth and forth. So on 1:1, 1:1, it means that in each trade you are taking, your TP, your take profit should be greater than or equal to SL. Like if you're having a stop loss of 50 pips, your take profit is 7 pips.
Yes.
So if you lose one trade, you lose -50. The next trade, if you win, you earn 70. So aggregate here, you have a +20.
Yes.
This is 1:1. For 1:2, your TP should be twice
Okay.
or greater than twice your stop loss pips. Like if your stop loss is 30 pips, you use a TP of 70 pips, go forth. Like if you lose two trades, so here if you trade three trades, and you lose two, you win one trade, you will still be in profit using this risk management.
Right.
Like if you lose two trades, you get -60 pips. And if you win one trade, you get +70 pips. So aggregate, you will have a +10 pips.
Yes.
So you'll still be in profit there. So on 1:3, if you use 1:3 as your risk management, it means that on the 4 trades you are taking, if you lose 3 and you win one trade, you'll still be in profit. So your TP will be greater than or equal to thrice your stop loss pips. So if you're using the stop loss of 30 pips, your TP should be at 100 pips, around that. So you get a -90 pips. When you plus the 100 you won, you get a +10 pips. But if you have the skills, then
Yes.
on the 4 trades you take, you may win all the 4 trades or you may lose only one trade. That's the
Right.
importance
Okay.
of having the skills that I gave you. So choose your risk management wisely and do not go off your risk management. If you are putting in every trade, if you're using a stop loss of 30 pips, stick to that. If you're using
Okay.
a take profit 100 pips, stick to that. Do not stretch out until the trade has hit your take profit or it has hit your stop loss.
Okay.
Okay. Now we have the money management part. So the main aim to enter in this risk business is to make money. So you should always protect your capital and your profits. How do you protect your capital? If you choose your risk management, then it should match with the capital and the contract size you're using. When I say the contract size, I mean the lots.
Yes.
And how do you protect your profit? You protect your profit by trailing stops, like breaking even. Like you have a profit of 2 times ADR. You have like 200 pips running, and you have not break even at least maybe 100 pips, so that if the trade may come back, it will take you out in profit. That's how you
Okay.
protect your profit.
Okay.
So let's take an example here. You have a $100 account and your risk management is 1:4. So that means in 5 trades, if you lose 4, you win 1, then you'll be in profit. This is 1:4. So suppose now Your SL is 30 pips,
Okay.
your TP is 150 pips. Suppose the first 4 trades, you lose the first 4 trades. So you enter the first trade, it's a loss, the second, the third, the fourth, and the fifth now is going into profit. Now, let's take a look on the contract side. You're using a 0.01 lot size. You get 4 losses. It will be around negative 120 pips.
Yes.
So negative 120 pips for 0.01 lots is around negative 12. So you have negative 12. Negative 12, you come to win 1. That means you have 150 pips, you have plus 15.
So you're up 30.
You are up 3. So your account will have $103. Okay?
Yes.
Now let's take a look. You're using 0.1 lot size. You get 3 losses, and the 4th one you get a win. You have a negative 90 here. Your account will remain with $10. Fortunately, you have $150 here. So if you add 10 plus 150 is 160. So your account will have around $160. But here you're using Y ratio for risk management. Suppose you lose all the 4 trades, the first 4 trades, then you have negative 120.
Right.
Negative 120, your equity is all burnt. So you lost all your capital. When you use a 1 lot, that means negative 10 pips, your account is burnt. So for proper risk management and money management, we usually use these rules, yeah?
Okay.
Like for $100 account, you enter a 0.01 lot, but 3 positions per trade. Like you see an entry, you enter 0.01 times 3. So per trade, you take a lot size of 0.03. Think you get me there?
I lost you.
Can you hear me?
Now I can.
So you have a $100 account. So the dealer has given you an entry here, your W. So your entry is here. You enter 0.01 lots,
Okay.
but you enter 3 positions. So here you enter 3 positions. Like you have your first position, your second, and the third. So you have 3 trades here. So per entry, you will use a 0.03 lot size in aggregate. This is for proper risk management. So for $200, it will increase to 0.02. So in aggregate, we have a 0.06 lot size. And in using this money management rule, if you get a loss using a 0.03 lot size, you should come back to the market with the same lot size because it needs to match with your risk management.
Okay.
So you should come back to the market with the same lot size in order for you to accumulate the profit that will cover for the loss. So you should not come back with the...
I lost you.
Can you hear me now?
Oh, yes, I can.
Okay, I was telling you that in using the money management rules, if you have a loss using a 0.03 lot size, you should come back with the same lot size. You should come back with a 0.03 lot size in order to cover the loss that you have and be in profit. If you come back with a smaller lot size, 0.01, it will be difficult to cover the loss that you got from 0.03. Okay?
Okay.
So these are the lot size and the prop for the accounts. and do not go off your money management rules. So you choose your risk management and money management rules and you settle with them.
Okay.
This one is the SWOT analysis. SWOT analysis, here you measure your strengths, your weaknesses, your opportunities and threats. This is done by a trader himself or herself. So you should do it. And because you are new in trading, so I advise you to take your time to trade first and come back to do the SWOT analysis. So these are the strengths. So you pick some of the strengths that you have, the weaknesses, the opportunities that you have, and the threats that surround you.
Okay.
And then you know that you would understand yourself, you would understand your trading behavior, so you know where to how do you say this? When you understand your behavior, then when you understand yourself, you can find the English for that. You know where to correct your mistakes in order to perform better. Can you hear me? Amy?
Yes, now I can hear you.
So on doing the SWOT analysis, there you would understand the trading behavior that you have, you would understand your behavior as a trader. Then on the part where you know these are mistakes that I make, so you would know how to correct your mistakes. Okay?
Okay. Yes.
I have a few tools that I use. I have the pick checkbook and the trading journal. This is the pick checkbook and the trading journal. So this one is the pick checkbook. This is a trading journal. This is a pick checkbook. It has a list of pairs here. So you list your pairs that you're trading. You mark which level are you. For example, you're level 3. What's the ADR there that has completed? It's only 2 times. What day is it? It's Wednesdays. So the trend is downtrend. What's the daily chart saying? What's the weekly chart saying? What's the TDI on the hour 4 saying? What's the harmonics on the hour 4 saying? So if it's a peak, you will say that if it's a if there is a consolidation or there is an outside structure, and you hunt for the peak there. So these are the stop loss and the TPs that I use for.
I like that.
For a swing trade. So this is a pick checkbook. It helps you in analyzing. And this one is a trading journal. So here you have your pairs down here. So at each pair, for example, Euro USD, this is a day. Day is Monday to Friday. So if you enter a trade on Tuesday, so you enter there, it's Tuesday. What's the trade type? So this is where you learn how to be selective with the trade. So it's a pick trade maybe, or it's an ID50, or it's a safety trade. So what's the London pattern there? It's the type 1 or type 2 or type 3. What's the time in there? It's around gap time. Where did you put your SL? It's your TPs, 30 pips, 20 or 50. Did I follow my plan? So here, did you follow your plan? Yes, I did. So you wait for your trade. And at the end of the day, you come to take notes. Like the trade ended up hitting my TP. There was an extended stop hunt. It's curtailed due to fear and all that. So this is a trading journal which will keep you in check on your trades. So at the end of the month, you review. You'll know which type of trades you didn't master. So you go back to the charts and mark the types of trades and all that. So this will also keep you in check.
Okay.
So I'll send you the 2 Excel sheets and expect my homeworks.
Okay.
This part now for training is over. The part that is training is for mentorship. So the mentorship part is usually more of you than me.
Okay.
So expect questions and homeworks for me to clarify.
Sounds good.
Otherwise, happy trading.
Thank you so much.
You're welcome. So I'll end here.
Sounds good.
Okay.
Thanks.
Thank you.